My name is Erwin Urs. I'm the academic coordinator of the English language finance degree programs at HEC Paris at the executive education level. And it's my pleasure and privilege to introduce Professor Denis Grand, who is the Antin Chair Professor of Finance at HEC Paris. Denis is a great colleague of mine let me introduce him very briefly, and then I'll leave the floor to Denis to start his case study. So Denis was born and raised in Paris. He attended the prestigious École Polytechnique, and from where he also graduated with a PhD in economics. He has served as a full-time faculty of MIT Sloan School of Management, London Business School, and INSEAD. And we are delighted to have him among our faculty in our department. Denis teaches and specializes in corporate finance, and he has won a number of teaching and case writing awards. His research covers corporate finance, banking, governance, and financial crisis, and he has published many important academic papers in leading academic journals. He's also the associate editor for a number of leading academic journals. So without further ado, I'll leave the floor to Denis, and I'll just remind you that after Denis' presentation, I'll be more than happy to answer if you would have any questions. The programs that we offer at HEC Paris at the executive education level, at the master's and executive certificate level. So Denis, floor is yours.
Thank you very much, Avren. Greetings to everyone. I'm speaking from the HEC Paris campus, which is not a frequent thing because of lockdown, as you can imagine. I've prepared a reasonably brief presentation on a short case. I believe all of you must have had access to the case. It's really a two-page case. If you haven't read it yet, it's not really a big problem for the presentation. But what I want to emphasize is that this is a very simple case that we get started with in many of our corporate finance courses. What I've prepared for us to discuss today is a short part of what we cover in the first day of corporate finance. And I've left some time for Q&A, of course, but it's just to give you a flavor of what we do. It's about financial dynamics, and more specifically about a small company in New Zealand called the Brick House, and as the name indicates, they essentially sell bricks. Now, something very important that we do in corporate finance is to try to separate, to the extent possible, business from finance, not because these are different things, but because it's very important to understand the business first before we can talk about finance. So what's the situation for the business itself? And what's the situation on the finance side? Let's start with the business very quickly. This is just a very, very brief summary of the case, which is already short. We're in early 2015 in Christchurch, New Zealand. Recently, about in 2011, the city, and in fact the region, has been hit by not one, but several earthquakes, which devastated the region and the city, also caused many deaths. And the company in question, the Brick House, is run by one lady, Lizzie Ward. She's the sole owner of the business. She has just a small business, 7 employees plus herself, and it's growing very fast, as you can imagine, following the earthquake and the huge rebuilding effort that's underway. So it's a very fast growing company, small company. What do they do? Usual thing, products, clients, suppliers, and so on. So what's the products? Well, essentially bricks. I'm lying, of course, not just bricks. It's bricks, blocks, tile, and other basic construction materials. Who are the customers? Well, to summarize, guys in jeans in pickup trucks. These are local building trade people. They are involved in building or refurbishing existing buildings. They need the material, they show up at the store. In fact, there are 2 stores now, and they go to their own work. The suppliers, these are large international companies. They give discounts, quantity discounts, which Lizzie has been adamant at getting for bulk discounts. So she purchases supplies, essentially bricks. She's not transforming them. She's just buying them and selling them on a bulk basis. Otherwise, what are the assets, the fixed assets? Well, very simple, 2 stores, a few trucks. I say fixed, well, the trucks are not fixed, but they are equipment. Okay, let's leave it at this for now, as far as business is concerned, and let's turn to the finance issues very quickly. What's the picture in the case? The company is reaching the limit of its credit line. What's a credit line? Essentially, it's a credit card for the company. There's a limit, $600,000. Whenever I say dollars here, it's going to be New Zealand dollars. She can borrow up to that amount. There's an interest rate that is paid on the amount withdrawn. Okay, so if she borrows 400K, she's going to pay 9.2% on 400K. There's also financing from accounts payable. So let's be clear about what accounts payable are. I'm not going to do a lot of accounting here, but what are accounts payable? Essentially, it's credit from your suppliers. You buy a bulk of bricks from your supplier, and the supplier agrees that you don't pay right away, you can pay later, and that's essentially a loan from your supplier. Now, the policy here is roughly that if you pay within 10 days, then you'll get a 3% discount, okay? And Lizzie has been very careful to pay within 10 days to the extent possible. I see a couple of people perhaps didn't get the case. Perhaps one of us can post the case, I'm not sure. Problem that the company is facing, it's been increasingly tough to pay suppliers in time. In fact, Lizzie has asked her own employees to be patient with pay rises. She's cut her own salary. She's been conservative about spending in order to meet those payments in time. At the same time, and this is really the center of the case, she's been negotiating with her bank a larger credit line, and the amount that she's requesting is 750. That's not on top of the 600, it's 150 on top of the 600K. The interest rate is to be determined, but yeah, we can work with 9.2%. In fact, we won't do much calculations with this today, but in principle, we could. All right, so this is the basic situation. Simple, fast-growing business facing financial constraints. Very, very typical. On top of that, the case provides a few financial statements. Again, we're not going to do much with this, but just the basics. The balance sheet, assets, liabilities. Here, the structure is extremely simple. Notice the bank debt that's been growing over time and almost reaching 600K, the limit in 2015 at the time of the case. Income statement is here. We'll talk about those in a sec. Now, this is the case. In case you haven't read it, this is what's in the case. What do we do with this? What do we do in corporate finance? Well, this may come to you as a surprise, but the first rule of corporate finance is to forget about finance. Before you do anything related to finance, and we will, we first have to forget about finance and focus only on the business. There are several reasons for this, but the main one is that corporate finance is the finance of corporations. So before we understand, we try to figure out what's the right way of financing a company, or what are the financial dynamics of a company, we absolutely need to understand the basics of the business in question. All right, so for some time, perhaps if we were in class, we would spend more time, maybe half an hour. Here, I'm going to spend a few minutes with you, focusing only on the business at hand. Now, as you saw, this is in principle a simple business. We're not talking about a semiconductor manufacturer or an online service provider. It's almost the simplest life form, with all due respect, of course, of business. And as you will see, it's still extremely important for finance issues to understand the basics. So let's try to understand the basics. And to understand the basics, eventually we'll need some numbers. And I'd like to know from you where I would look for those numbers. Suppose I wanted to know about the business itself, not about its financing issues. Where on the balance sheet should I look? Should I look on the asset side or on the liability side? I'm going to start a little poll for you. I'll just leave it a few seconds. It's just to get started. It's just to get started on the topic. Okay. So again, the question is: suppose I'm interested in knowing what's going on with the brick house business-wise. Should I look at assets or liabilities, or neither? Okay, I'll leave it open just a few more seconds. All right. Interesting. Majority of people said, almost half of you said assets, and I think that's very right. Think about it. Where are the trucks? Where are the customers? Where are the products you buy from the suppliers? They're all on the asset side of the balance sheet. So for every business, if you want to know, every company, if you want to know what the business is about, you should look at least at the asset side. There's one exception, of course: financial companies, banks, hedge funds, whatnot. Of course, their business is finance, so it's also on the liability side. Okay. Now, perhaps those of you who said neither mean, well, we should not only look at the asset. Maybe we should also look, and we will, at the income statement and perhaps some other financial statements. The cash flow statement will do a very small one in a few minutes. Okay, but this is very important. The bulk of the information about the business is going to be on the asset side of the balance sheet, right? As far as the accounting is concerned. That's important for us, as you will see in a second. Asset side. All right, so what is this business about? What is this business about? Of course, we could have a discussion, but in the interest of time, let me get started on the basics. This business is about construction materials. Lizzie is buying bricks from her suppliers and selling them to her customers. There's no transformation, very little value added. This is a commodity business. Basically, if her customers are not happy with the bricks, well, they can just go across the street and get the same bricks from another vendor. Okay, so it's a commodity business. And if you think about a commodity business, the strategy textbook will be, well, commodity business, it's about pricing and service. Why pricing? Because you don't control the price. You don't control the price. The price is the price of a brick. If your bricks are more expensive than those across the street, customers will go across the street. And because you don't control the price, it means you have to control your costs. How do you control your costs? Well, in a number of ways, but one major way in which Lizzie is controlling her costs is by buying her own supplies in bulk. What about service? Why is service so important in the commodity business? Well, commodities are non-differentiated by definition, so service is a feeble attempt at differentiation. I want to provide some service to my customers so that they come to me to buy the bricks that they can also buy across the street. Service, What's the number one service in this business? Availability of product. When the customers show up, the stuff has to be there. In fact, that's the motto of the company. We've got your stuff. Number two, flexible payment terms. When the customers show up, these are building contractors. They don't want to pay cash. Why? Because their own clients are not paying them cash. They want flexible payment terms. They want to be able to pay later. 2 weeks, 3 weeks, a month. We'll see this is very important. And then the third element of service, I've called this Lizzie. It's basically all the customer service. Lizzie is knowledgeable. She's nice, but she can punch you in the nose if needed. Her employees are well trained. They can advise you on price, on cost. They can advise you on regulation regarding earthquakes and so on. All right. So I'm not trying to pretend that I would be able to run such a business, but I think by introspection we can figure out what are the main issues, what are the main levers in this business at a broad level, and you will see it's very useful for understanding the financial dynamics of this business. Now, given this, let's imagine that this is a fair rendition of what this business is about. Where will this show up on the balance sheet? Well, let's start with bulk buying. Where is this showing up on the asset side of the balance sheet? Remember, on the asset side, we have cash, accounts receivables, which are debts or loans that you have made to your own customers, inventory, and property, plant, and equipment. Where will bulk buying show up? In inventory. Yeah, the fact that you're buying loads of bricks at once means you're going to have loads of bricks sitting, waiting for a customer to show up. Inventory. All right. Now for you to work, what about product availability? The fact that when the customers show up, the product has to be there. Where is this going to show up on the asset side of the balance sheet? I'm launching a second poll. I think I've prepared three polls for you just to keep you on your toes. Where will this show up? Receivables, inventory, cash, PP&E, property, plant, and equipment, none of the above. The fact that products must be available. Okay, let me close the poll. I think you guys are almost done. All right. Now, of course, mostly in inventory. Inventory is basically what's in your warehouse. Now, of course, I see why people may have put cash, perhaps receivables, property, plant, equipment. Well, property, plant, and equipment, perhaps you need a bigger warehouse to store all this inventory. Cash, well, perhaps you need cash in order to be able to buy those goods, those products, those inputs, those bricks. But by and large, they will impact mostly your inventory. Okay, let's move on. Inventory. What about flexible payment terms? Where is this going to show up on your balance sheet on the asset side? Your customers don't want to pay right away. It's going to show up in accounts receivable. Remember, this is money that your customers owe you. And last, what about Lizzie? Where is she going to show up on the balance sheet? For all I know, she could be the main asset of this business. Nowhere. She's an intangible asset, not on the balance sheet. All right, so let's imagine that this is a fair picture, or at least it's our best shot at a fair picture of this business. Here's a trick of the trade. Let's go to the balance sheet and check whether our intuitive treatment of this business, rendition of this business, makes sense. Let's have a look at the balance sheet on the asset side. And I've put here the latest one. By the way, there's a little F here. I don't know whether you can see the pointer of my computer, but there's a little F because it's a forecast. 2015 is not over yet. If we look at the assets and as a percentage, each item as a percentage of assets, we see that receivables and inventory are indeed by far the most important asset items in this business. So what do we get from that? It's very important. It's very important because we understand that the brick house is essentially to its customers two things, not one. First, it's a bank. It is lending money to its customers. A big part of Lizzie's job is to shake hands with contractors and figure out whether they are a good credit or not, whether they deserve, so to speak, a loan from her. She's a banker. Bizarre, but true. And at the same time, the brick house is a warehouse for its customers. Why? Because it's storing inputs that it buys in bulk from its own suppliers, and because its customers want the products to be available. Now, being a banker is a very difficult job. Being a warehouse manager is a very difficult job. Lizzie has two jobs. She has to do both. We'll see that understanding the business like we did, even if it's a bit rudimentary here, is going to be very important to understand the financial dynamics of this business. Let me move on. Operating performance, I don't want to spend a lot of time on this here. Let me go quickly over this, over the main items. Obviously, the sales of this business are growing very, very fast, around 30% per year. This is very fast growth. The profits, you can see net income at the bottom of the income statement, positive and growing. Margins, be they EBITDA margins or EBIT margins. Of course, we could spend more time on those concepts, but here they are low. The margins are low because it's a commodity business. If we had seen here 25%, we would need to go back and check the numbers or check whether she doesn't have a side business dealing drugs. This is low margins. By definition, commodity businesses almost always will have low margins. There's no problem there. And then we should think about profitability. And let me not get into this, but basically we have different measures of profitability, which are more or less appealing. We can talk about it if you want in the Q&A. ROE, return on equity, ROA, return on assets, return on invested capital. Let me skip those for today, but I just wanted to mention them. It's very important to assess the profitability of the business. Okay, let's move to finance. Now that we have in our bag the business, let's go to finance and let's see what are the issues. The main issue here is very simple. Let's look at leverage ratios. I'll just mention a couple. There's a battery of ratios we could look at, but debt to equity, liabilities to equity, these are measures of the indebtedness, overall indebtedness of this business. We can also look at liquidity ratios, which are not just comparing the size of the debt to the size of the business, but which are more about whether this business is likely to meet its debt repayments in the short run or not. Interest coverage, current ratios. Again, we could spend more time on this today. Let me accelerate in the interest of talking about more interesting things for today. What happens if we look at these ratios? Well, we'll see that whatever ratio we look, whatever leverage ratio we look at, leverage ratios are going up very fast. Liquidity ratios are going down very fast. This company is getting more and more indebted and less able to service the debt in the short run. And the question is why? This is a very important question. It's a very important question that Lizzie should ask herself, but it's also a very important question that the banker will ask themselves before extending the credit line. Let's have a look. One thing to do here, very simple, is to follow the money. Now, in principle, we should look at what is called a cash flow statement, but here we'll do it very, very quickly. That's something you can do, while you're on the phone, looking at two balance sheets. Here I've taken 2012, the year just after the earthquake, and 2015, the latest balance sheet, and you just compare item to item across these 2 years. And you'll classify uses of funds and sources of funds. Uses of funds are asset items that go up between 12 and 15. Or liabilities that go down between 12 and 15. Why is an asset going up a use of funds? Well, let's say your property goes up because you bought a truck. Well, you had to get money and put it into the truck, into buying the truck. That's a use of funds. If your liability goes down, let's say your debt goes down, your bank debt goes down, you had to get some money and use it to repay partially or fully the bank debt. What about sources of funds? It's the other way around. Liability going up, your bank debt goes up, for instance. That's money you got that you could use somewhere else, let's say in inventory. Assets going down. You have not renewed your assets, or perhaps you have sold some assets. Now, I'd like you to look very quickly at these two balance sheets and just, in your mind, roughly, do a poll on this. Tell me what has been or what have been, I think you can get only one answer here, but what's been the main use of funds for this business? Again, a use of fund is assets going up or liabilities going down. What's been the main use of funds for this business? Sorry, I didn't launch the poll. You can just compare the two balance sheets. Has it been building up cash reserves, receivables, inventory, PP&E? I'll let it run for a few more seconds. It's not an exam. I won't take names at the end, don't worry. Just to make sure you're following. Plus, it's a tool. It's a real tool that you can use very easily to look at any kind of business. In principle, we should be building what is called a cash flow statement to really check where the cash is coming from and where it's going. But as a first pass, we can just do this, compare two balance sheets. Okay, let me publish the results. Yes, the main one has been accounts receivable. Close second, inventory. And then property and equipment is really in the distance. Of course, it has increased, perhaps because of the new store, perhaps because of some new equipment, but mostly, and by far, it's been accounts receivable and inventory. And by the way, this is great news for our initial analysis, because we said this business is mostly about receivables and inventory. It's mostly a bank and a warehouse. And we see it here in the financial dynamics. Most of the money has gone into inventory and receivables, but where has it come from mostly? Mostly from the bank, 414. This dwarfs completely the other two potential sources, accounts payable, that's the suppliers, and equity. What is equity here? The change in equity is 89. These are the profits this firm has realized, the net income, the sum of the net income between 12 and 15. Okay, we're getting there. Most of the money has gone into receivables and inventory. Why is that? Well, because the business has been growing so fast, and we know the business is about receivables and inventory. If the business is growing at 30%, then almost by definition, receivables and inventory will go up. I see someone is raising their hands, but maybe you can type the question in the chat, and we'll have some time at the end for Q&A anyway. What about the fact that most of the monies come from the credit line? How come? Well, that's really by elimination. Where could it come from? It has to come from somewhere. If we want to fund this increase in receivables and inventory, the money has to come from somewhere. Where can it come from? There's only three sources of funds for this company. Bank debt, okay, that's where it came from. What would be the alternative? Accounts payable, that's loans from your suppliers. But Lizzie has been adamant to pay in time, within 10 days to get the discount. We could debate whether that's a good idea. It turns out it is a good idea. But because of that policy, very little can come from the suppliers. And what about 89? These are the profits. They are far from enough to cover the needs. This is a company whose growth is outpacing profits by a very wide margin. That's the financial dynamics of this company. Fast-growing company, low margins. Even at the best of time, there's nothing wrong with the low margins, but it's growing so fast that there's no way this growth can be financed internally. And so here it has to come from suppliers, but no, because of the 10-day policy. And therefore it has to come from the bank debt. Now, why is this a concern? Because if it eventually has too much debt, this company might very well default. All right. Very quickly, let's take a step back from the company and then let's wrap up. Let's think about the financial dynamics of different companies. Let me start with, we've just seen a company whose growth is outpacing its profits. Let's look at Procter & Gamble, huge multinational. Consumer products. This is profitability. If you want, we could get into the details, why ROE, not ROA. Okay, this is the growth rate of equity. Let's look at the growth rate of the business. Growth rate of equity is 10%. Growth rate of the business, basically zero. In fact, the assets of P&G has been going down. Sales growth, almost flat. This is a company whose profits are outpacing its business growth. Remember, business and finance. Profits are outpacing business growth, therefore, it's mechanical. Leverage, indebtedness will go down. In fact, perhaps down below zero, meaning the company is going to start accumulating cash unless it takes action. Pays dividends and or buys back some of its own shares. And you've guessed it, P&G do both. They have a huge dividend program and a huge repurchase program. Okay, so this is a company that's at the other end of the spectrum from the brick house. Slow growth, high profitability. The general dynamics is to accumulate cash and reduce financial debt. Let's look at a very different company, Tesla, just for kicks. What's the ROE of Tesla? Basically negative. They're making losses, at least accounting losses. What about their growth? Huge. Sales growth, this is an average over a few years, 55%. Asset growth, 15%. Growth outpaces profits. By the way, they have huge investment plans, more than $3 billion per year for the next few years. So growth definitely outpaces profits. Okay, what are the financial dynamics of this company? Number one, leverage will increase unless they do something about it. What does doing something about it mean? Cut dividends or issue equity. It's the opposite of P&G. Guess what? They don't pay dividends, so fine, that's great. And they issue equity. They have issued equity recently. They've issued equity several times, but recently they issued some more equity. And part of the reason was in order to be able to finance their growth without over borrowing. Okay, the brick house. profitability, ROE 12%, sales growth 30%, growth outpaces profit, just like for Tesla. So dynamics are the same. Leverage will increase unless they cut dividends or issue equity. But is that something they can do? Well, first of all, there's no dividends to cut. All right. But can they issue equity? And more broadly, what is the end game for the brick house? Let me review the possible scenarios, and then we'll wrap up. First, okay, continue as is. More growth, and therefore more debt. They'll go bust. This is a definite possibility, going bust. Number two, improve profitability. Improve profitability, all right, perhaps they can increase their profitability in order to increase the financing of the internal financing of their growth. But remember, profits are way below their financing needs. So even if they double profits or even triple profits, which of course is not going to happen, this is not a business where you can increase profitability, where you have huge margins of improvement. It's a very, very thin margin business. Not going to solve the problem. Okay, grow slower. That may be what they have to do. You have to convince Lizzie. Remember, she can punch you in the nose. Or perhaps the bank can put some conditions that are de facto going to slow down the business. Last, more growth, but finance with equity. I see that one of you suggested doing an IPO. This business is way too small for an IPO, but perhaps they can find some more equity. Maybe Lizzie can sell her apartment, she can liquidate her life insurance, she can get money from her friends, family, or soon to be ex-friends. She could find a partner. Very difficult for a small business like this to find a silent partner, because as a partner, imagine you get in, you put your money, but when do you get your money out? Or sell the company? One of you asked, why would the brick house go bust? Well, they're growing super fast. Their profits are not enough to finance the growth, so they're financing it with debt. Eventually, they will default on their debt if they have too much debt, and they will go bust. Okay, so these are the likely scenarios. We could elaborate on this. Maybe we can do this in the Q&A. I just want to wrap up. What are the takeaways? We have a methodology. We look at the business, no finance, then we describe the recent financial history, look at levels and trends, and then we start the analysis. Here we've scratched the surface of the analysis. We would spend much more time in class, of course, but I think this gives you a good, I hope, a good taste for what we would do. What are the issues that we would need to discuss further? Number one, how much debt do they really need? And here we could develop a tool of financial forecasting for this company. And second, how much debt can they really afford before this becoming dangerous and the risk of going bust increases? Okay, so these are the issues. Let me stop here and then maybe we take a few questions. Thank you all for your attention. This is my contact detail. And of course, there's going to be more to come, but if you have any questions about our programs, in particular the Executive Master in Finance program, here's the contact. Let me take a few Q&A if it's okay, Everin, and then I'll leave it to you.
Yes, please. I think Jean-Pierre was raising his hand, and maybe you can ask the question now.
Let's see whether I can actually even give him the Jean-Pierre. There you go, Jean-Pierre. I think I've, no? Did.
Hello, everyone. No, I didn't actually. It's a mistake. I didn't.
Okay, sorry, okay.
Sorry for that.
Sorry about that.
Any other questions?
I see a question about why would the brick house go bust? So you're right to say, I think this is a question by Nas. You're right to say that so far the company is doing fine. business-wise. We could debate that. We haven't looked really into whether they are profitable enough, but as the fraction of debt goes up, your margin of safety in your ability to pay the debt is going to go down. And eventually, a small downturn or perhaps a small delay in repayment by your customers is going to push you over the edge and make you default on your debt. So that's the problem. By the way, it's a very typical issue for fast-growing firms. Many fast-growing firms are very successful and grow themselves into default, into bankruptcy, just because they chew more than what they can handle finance-wise. I mean, business-wise, they can handle it, but the finance implications, they cannot handle. I see a few questions in the Q&A. Nowadays, in crisis, liabilities are key. I guess this refers to the initial question of where would you look if you want to know about the business. It depends a little bit what you mean about the business. Okay, so what I meant is this business running well? Is this well run? Is this a well-run brick house? Or is Lizzie doing a worse job than the guy across the street? You don't need to look at liabilities, you look at assets. I think what you mean by saying, now in a crisis, liabilities are key is that, yeah, if you start defaulting on your liabilities, or if you're unable to meet payments, be they payments to your banks or to your suppliers, this will have an impact on your business, absolutely. Okay, but the impact will show up on the asset side. Why raising equity was not exposed here? Well, raising equity, let me summarize a little bit crudely. We're not talking about a high-tech startup here. We're talking about a very small, very conservative industry type of business. This is not a company that will find it very easy to raise equity. The number one source of equity for these small companies are profits and money of the entrepreneur, by far. Why? Well, by introspection, think about it. Would you invest your money? Would you invest several $100,000 New Zealand dollars? I'll let you do the conversion into your own currency, into Lizzie's business. When you start thinking about it, yeah, she's good, but when do I get my money out? And how do I get it out? Is she going to start paying dividends? When I want out, when I want to get, I've put 300K, maybe it's grown to 500K. How do I get it out? Somebody else is going to buy it from me? Who? Is she going to buy it from me? With what money? Okay, so these are the big problems. And if we have conflicts, how are they resolved? So I'm not saying it's impossible. I'm just saying it's not as easy as for Tesla. Tesla is a publicly traded company. They can sell shares on the market. Why does, oh, that's a very good question. Why does P&G pay dividends? We see why there can be such a thing as too much debt. But I think we're asking, can there be such a thing as too little debt or too much cash? This is the topic for a whole session that we could have. How much cash should your company have? And is there such a thing as too much cash? Let me just say it briefly. The answer is yes. Why can there be such a thing as too much cash? Two main reasons. Number one, tax implications of cash holdings, negative. Number two, investment discipline. In many industries, when investors see that the company has piled up a lot of cash, they are worried about what the company is going to do with the cash. They're going to start overpaying in acquisitions, making acquisitions they should not be doing, etc. So that's why P&G is keeping some money, but paying out a lot of cash. By the way, they're paying, I think I checked yesterday, their payout ratio, if you add up dividends and share repurchases, is more than 150% of their profits. So they're shrinking. What is reasonable leverage between equity and debt in this case? Here it's difficult to say, right? Because it's, in general, this would be a fairly cyclical business. doing well in booms and bad in downturns. So this is a recipe for not having too much leverage. At the same time, this is an unusual boom. It's a boom that was caused by the earthquake. So she has to ride it as much as she can. So I'd say, yeah, moderate, over the average, above average leverage for this company, at least in the short run, but eventually return to more moderate leverage. To what extent is share buyback unethical? I don't know whether it's unethical, but I think what you're referring to is more. It could be two things. One is, I think the main one that is this refers to is insider trading. When the company buys back shares, it buys back shares from its own shareholders, but who is buying the shares? The company, but the company is not the person. So it's the remaining shareholders who are buying shares from the other shareholders. And some of the remaining shareholders are long-term shareholders, management. They may know things that regular shareholders don't. So there's an insider trading element to buying back shares. And that's why share buybacks are heavily regulated in terms of what information is what information is available to investors and how many shares, what volume of shares can be bought on any given day. Let me take a couple more questions. Is the business successful? In fact, we can't really answer this here because we haven't looked in details at the operating performance of this business, whether the return on invested capital is high enough given this business. Turns out not great, in fact. Could Lizzie offer an incentive to her suppliers and to her customers? Absolutely. So perhaps she can get better deals from her own suppliers. She could incentivize her credit for her customers to repay faster. That's in a way improving profitability. My sense is that she can do only so much with this. Remember, her profits don't cover even a fifth of the money she needs. So let's even say by doing this, she doubles her profits. No way. Okay, let me, I see there's a few more questions. Let me leave it at that for now. And obviously you can contact me if you want, no problem. I'll leave in the interest of time, I'll leave it to Evelyn for now. Thank you very much to you all. Thanks for all your questions.
Denis, thank you very much. At some point, I think we were 115 participants, so very much appreciate the participation. I will want to take a few minutes of yours, or would like to offer a few minutes to share some additional information and provide more information about the programs that we offer. So hopefully my screen will function properly.
It's okay, Aaron. We see your slides, but we see all your slides at the moment.
Right. Thank you, Claudia. So Denis is part of the team who's teaching in our Executive Master in Finance program. And that's why, given that he was presenting this case, I would like to take the opportunity to say a few things about our English language executive programs in finance. So one of them is the Executive Master in Finance. This is our flagship program. It's a 18-month-long modular master's degree. Modular meaning that it's a part-time program that you can attend through 5 modules, which are roughly 1.5 months apart. Each module is about 8 days. And the content coverage is roughly half of it is about corporate finance, roughly 1/4 of it is about financial markets and asset management, and then the rest is topics that we think are very relevant for corporate and financial sector executives, such as how do you assess country risk, how do you improve your negotiation skills, how do you think about the business and corporate strategy, and some of the key issues in accounting, such as fraud, for example. And the participants are typically coming either from the corporate sector, so 2/3 are corporate sector executives, and 1/3 are financial sector professionals. these are very rough averages. We do have an executive certificate that's an integral part of this program. So this is some of the courses are bundled to create this executive certificate. And it's a 12-day long certificate program. It's, again, fully taught in English, given that it's coming from the other program. And you have an idea about the topics that are being covered. It's really gives you solid fundamentals about valuation. And finally, we have a similar executive certificate program, but this time it's in asset management. And here the emphasis is about the asset management industry, the stock markets, and the bond markets, and how do you use derivatives and for your risk management. So if you would be interested in having more information about these, well, there is going to be a full-blown webinar on this a week from today. And you can contact Jonathan Ratcliffe for more details. And otherwise, I can take a few questions about these programs should you have any questions.
Evan, I would like to only add that all of you will get an invitation for this webinar. We have also invited some alumni to this webinar, so you can chat with them a little bit about their experiences. And we would be really pleased to see you next week again in our webinar. I'm the program manager on this program. My camera is not working very well today, so I have to apologize, but I will fix this until next week, promised.
So Saud Al-Saidi was asking a question. The program is actually not online. It's basically through physical presence. You have to be on our campuses, either here in just outside of Paris or in the Paris. So it's not an online program at this point. Any other questions that I might be able to help answer? So if there are no further questions, we very much thank you for being with us today. If there are any questions, you can contact Jonathan Ratcliffe at this email address that Denis has provided. And we hope to be able to see you next week for more insight about our programs in the executive education arena in finance. So Professor Grome's email is as such. So it's his last name at hec.fr. And I very much thank him for being with us today and sharing his knowledge, which he does even more so in the Executive Master in Finance, as well as in the Executive Certificate in Valuation programs. Thank you all.
Goodbye.